Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah Chen, and joining me as always is Mike Torres, our senior industry analyst. Today we're cracking open FedEx's FY2025 10K filed July 20th, 2026, covering the fiscal year ended May 31st, 2026. Mike, this is a filing with some genuinely structural news buried inside it, not just the numbers.
That's right, Sarah. And I want to flag something up front for our listeners. This filing is unusually heavy on corporate restructuring disclosures relative to the financial performance narrative. We're going to be rigorous today about what the filing actually tells us versus what it doesn't. Let's get into it.
Mike, let's start with the core thesis. If you had to reduce this entire filing to one sentence, what is it?
If we reduce this filing to one sentence, it's this. FedEx is deliberately shrinking its own perimeter, spinning off its freight division, changing its fiscal calendar, and restructuring its segment reporting, while sitting on a balance sheet that shows $34 billion in revenue and $13 billion in cash, which means this is a company engineering a leaner identity, not responding to a crisis.
That's a sharp framing. And where does that put FedEx in the business cycle?
Based on this filing, FedEx is operating in what I'd classify as a structural reset phase. This is not early recovery, it's not late cycle peak. It's a company that has made deliberate board-level decisions to redefine what FedEx actually is. The spin-off of FedEx Freight, the fiscal year change, the segment restructuring, these are not reactive moves. They are architectural. We'll come back to test that thesis at the end of the episode.
Let's move into the material changes. Walk us through the headline numbers first.
So the XBRL data gives us the top-line picture. Revenue came in at $34.37 billion for FY 2025. Operating income was $5.46 billion, which translates to an operating margin of approximately 15.9%. Net income was $4.43 billion. Now, I want to contextualize those numbers immediately because raw figures without a benchmark are meaningless.
Agreed. What's the benchmark here?
For a large-scale integrated logistics and express freight operator, operating margins in the 10 to 16% range are considered healthy mid-cycle performance. FedEx, at 15.9% operating margin, is sitting at the upper end of that historical range for the integrated freight sector. That's not a company in distress. That's a company generating strong returns on its network.
And net income at $4.43 billion on $34.37 billion in revenue. That's a net margin of roughly 12.9%. How does that read to you?
For a capital-intensive logistics network, a net margin above 12% is genuinely strong. Integrated freight operators have historically run net margins in the 5 to 9% range through normal cycles. So 12.9% is an outlier on the upside. Now, I want to be careful here. The filing as provided does not give us a prior year comparison in the extracted MD&A content. So I cannot tell you whether this represents improvement or deterioration versus FY 2024. What I can tell you is that in absolute terms, these are robust numbers.
Let's talk about the structural changes, because those are arguably the bigger story in this filing.
Absolutely. The filing discloses two seismic structural events. First, in December 2024, FedEx's board of directors decided to pursue a full separation of FedEx Freight. That's the less than truckload business. The filing is explicit. The board decided to pursue a full separation of FedEx's less than truckload freight transportation services business conducted through FedEx Freight, Inc. That's a direct quote from the filing.
And that separation actually completed during the filing period?
It completed just after the fiscal year end. On June 1st, 2026, one day after the fiscal year closed, FedEx stockholders received 1 share of FedEx Freight common stock for every 2 shares of FedEx common stock held as of the May 15th record date. FedEx retained 19.9% of the outstanding shares of FedEx Freight Holding Company. So the FY 2025 10K captures the company in the final moments before that separation took legal effect.
What's the causality chain there for investors?
Here's how I model it forward, strictly based on what the filing discloses. If the spinoff proceeds as described, and it already has as of June 1st, 2026, then FedEx's consolidated revenue base shrinks because FedEx Freight is no longer a reportable segment. That means the $34.37 billion revenue figure we're analyzing today represents a FedEx that includes freight. The post-spin FedEx will be a smaller company by revenue. If investors are benchmarking FedEx's future revenue trajectory against this FY 2025 number, they're comparing against a baseline that includes a business that has since been separated. That changes the investment case materially.
And the second structural change?
The fiscal year change. Effective June 1st, 2026, FedEx moved its fiscal year end from May 31st to December 31st. The filing states there will be a 7-month transition period report covering June 1st through December 31st, 2026, with calendar year reporting beginning fiscal year 2027. This is significant because it means the next comparable annual period will be a non-standard 7-month stub, which complicates year-over-year analysis for at least 2 reporting cycles.
Let's talk about what management is actually saying. The tone, the language, the signals embedded in the MD&A.
I want to be transparent with our listeners here. The MD&A excerpt provided in this filing is unusually sparse on operational and financial narrative. What we have is primarily the boilerplate forward-looking statements disclaimer, the corporate overview, and the structural announcements. The filing itself directs readers to item 8 for the detailed financial notes. So I'm going to work with what's explicitly on the page.
What does the forward-looking language tell us?
The filing lists the standard forward-looking qualifiers. Words like will, may, could, would, should, believes, expects, forecasts, anticipates, plans, estimates, targets, projects, intends. That's boilerplate. But the tone around the structural changes is notably decisive, not hedged. The language around the spinoff is not we are exploring or we are evaluating. The filing states the board decided to pursue a full separation. Past tense, decided. That's conviction language.
And the fiscal year change? Same decisiveness?
Same register entirely. The filing states, effective June 1st, 2026, we changed our fiscal year end. Not we plan to change, we changed. These are accomplished facts being reported, not aspirations. From a tone analysis standpoint, this is a management team that made big structural bets and is reporting them as completed actions. That's a very different posture than a management team in defensive mode.
What about the description of FedEx's core business identity? Any signals there?
Yes, and this is worth noting. The filing describes FedEx as providing customers a broad portfolio of transportation, e-commerce, and business services, offering integrated business solutions utilizing its flexible, efficient, and intelligent global network. The emphasis on integrated and intelligent is deliberate brand language. Post-spin, FedEx is positioning the remaining entity, Federal Express, the express transportation and ground delivery business, as the core of that integrated identity. The freight business, by contrast, is being separated out as a standalone entity.
So management is essentially saying the LTL freight business is not core to that integrated vision?
That is precisely what the structural decision communicates. And the filing is explicit that prior to the spinoff, the 2 reportable segments were Federal Express, described as the world's largest express transportation company and a leading North American provider of small package ground delivery services, and FedEx Freight. Post-spin, Federal Express is the company. That's a significant narrowing of scope.
Let's move to the balance sheet and flag anything that warrants scrutiny.
Starting with the confirmations, because there are genuine positives here. Cash and equivalents stand at $13.31 billion. For a company with $34.37 billion in revenue, that's a cash to revenue ratio of approximately 38.7%. To put that in context, large integrated logistics operators typically carry cash reserves equivalent to 10 to 20% of annual revenue. FedEx, at nearly 39%, is carrying an exceptionally strong liquidity buffer.
That's a significant cash position. What's the other side of the ledger?
Total debt is $23.45 billion, and the filing classifies all of that as long-term debt, $23.45 billion. So the net debt position, cash minus total debt, is approximately negative $10.14 billion. That means FedEx carries more debt than cash by about $10 billion. Now, for a capital-intensive network operator, carrying net debt is normal. Airlines and logistics companies routinely operate with net debt positions. The question is whether the debt load is serviceable.
Walk us through that serviceability question.
With operating income of $5.46 billion and total debt of $23.45 billion, the gross debt to operating income ratio is approximately 4.3 times. For investment-grade logistics operators, a ratio below 4 to 5 times is generally considered manageable. FedEx is sitting right at the upper boundary of that comfort zone. It's not alarming, but it's not a balance sheet with significant additional borrowing headroom either.
Is there a causality chain here that investors should track?
Here's the one-eyed flag. The spinoff of FedEx Freight removes a revenue-generating segment from the consolidated entity. If the remaining Federal Express business carries a proportionate share of the existing $23.45 billion debt load, but now generates less consolidated revenue, the debt-to-revenue ratio worsens on a post-spin basis. The filing does not specify how debt is allocated between the two entities post-separation, which is a gap in the disclosed information. If that debt allocation is unfavorable to the remaining FedEx entity, the leverage picture looks more stretched than the FY2025 numbers suggest.
That's a real flag?
It is, and I want to be clear. I'm not speculating that the allocation is unfavorable. I'm saying the filing does not tell us, and that absence of disclosure is itself worth noting.
Let's talk risks. What's the filing telling us on that front?
The filing's risk factors section, based on the data provided, did not identify new or significantly escalated risk factors versus the prior filing. The forward-looking statements disclaimer references Item 1A risk factors in the standard way, noting that actual results may differ materially from those contemplated by such forward-looking statements. That's standard language.
But the structural changes themselves create new risk vectors, don't they?
They do, and this is where I want to be precise about what the filing discloses versus what I'm inferring. The filing explicitly states that as a result of the spin-off, FedEx will no longer consolidate the FedEx Freight business. That's a disclosed fact. The risk that flows from that, execution risk around the separation, potential stranded costs, the complexity of the 7-month transition period reporting, those are risks that the structural disclosures imply, even if the risk factor section doesn't escalate specific language around them.
What about the fiscal year change as a risk factor?
The 7-month transition period is genuinely unusual. Investors and analysts will be comparing a 7-month stub period against full 12-month prior periods. Seasonal patterns in express freight, holiday shipping volumes, for instance, will be captured differently in a June through December window than in a June through May fiscal year. That creates comparability risk for at least 2 annual reporting cycles. The filing acknowledges the transition period exists, but does not quantify the comparability impact.
Any aviation sector specific risks worth flagging from what's in the filing?
The filing describes FedEx as operating a global network dependent on air transportation infrastructure. The standard risk universe for an operator of this type includes fuel price exposure, air traffic control disruptions, international regulatory complexity, and labor agreements across a large workforce. The filing references these categories in its standard risk framework without escalating specific language on any of them in the excerpt provided.
Let's go deeper on liquidity. Mike, stress test this balance sheet for me.
Starting with the strongest point, $13.31 billion in cash and equivalents is a fortress level liquidity position for a company of this size. To benchmark it, major integrated logistics operators have historically maintained cash reserves of $3 to $6 billion. FedEx, at $13.31 billion, is carrying more than double the high end of that historical range. That is not a company running on fumes. That is a company that has deliberately accumulated a war chest.
Why would you accumulate that much cash?
The filing gives us a direct answer: the spin-off. Separating a major business unit is expensive. Legal fees, restructuring costs, potential debt refinancing, transition service agreements. A $13 billion cash position gives management the flexibility to execute a complex separation without being forced to access capital markets at an inopportune time. From a capital allocation lens, this cash position reads as purpose-built for the restructuring.
What about debt maturities? Does the filing give us a schedule?
The filing references the long-term debt and other financing arrangements, note in Item 8, but the detailed maturity schedule is not in the extracted MD&A content. What we know is that the full $23.45 billion is classified as long-term, which means no material near-term maturity cliff is being flagged at the top line level. That's a positive structural indicator.
Lease obligations?
The filing references a leases note in Item 8, indicating lease obligations are disclosed in the financial statements. For an operator of FedEx's scale, running one of the world's largest commercial aircraft fleets alongside a massive ground vehicle fleet and extensive real estate footprint, lease obligations are a material off-balance sheet consideration. The filing acknowledges their existence, but the quantum is in the detailed notes rather than the MD&A excerpt.
Let's talk segments. This is where the story gets genuinely interesting given the spin-off.
The filing is explicit about the pre-spin segment structure. Prior to June 1st, 2026, FedEx had two reportable segments, Federal Express and FedEx Freight. Federal Express is described as the world's largest express transportation company and a leading North American provider of small package ground delivery services. FedEx Freight was the LTL business. Post-spin, Federal Express is the only remaining segment.
So the $34.37 billion revenue figure, how much of that was Freight versus Federal Express?
The filing directs us to the segment financial information in Item 7 and the business segments and disaggregated revenue, note in Item 8, but the specific segment revenue split is not in the extracted MD&A content. What I can tell you is that historically, FedEx Freight has represented a meaningful but minority share of consolidated FedEx revenue. The express and ground business has always been the dominant revenue driver. But I will not put a specific number on that split without it being in the filing data provided.
What does the retention of 19.9% of FedEx Freight tell us?
It tells us FedEx is not making a clean break. Retaining 19.9% means FedEx maintains an economic interest in the freight business's performance without consolidating it. From a balance sheet standpoint, that 19.9% stake will likely be carried as an equity investment going forward. If FedEx Freight performs well as a standalone public company, that retained stake has upside value. If it struggles, FedEx has limited exposure. 19.9% is below the threshold for equity method accounting in most cases, and well below consolidation thresholds.
So, it's structured as a financial option more than an operational commitment?
That's a fair characterization based on the structure the filing describes. The 80.1% distribution to shareholders was the clean separation. The 19.9% retention is the hedge.
Let's close with what investors and traders should actually be watching. Mike, what are the key monitoring metrics coming out of this filing?
3 things grounded strictly in what the filing discloses. First, watch the transition period report. The 7-month stub covering June 1st through December 31st, 2026 will be the first look at FedEx as a post-spin, post-freight entity. That report will tell us what the Federal Express only revenue and margin profile looks like without the LTL business in the mix. That's the new baseline.
Second,
Second, watch the debt allocation disclosure. When the transition period report or any interim filing clarifies how the $23.45 billion in long-term debt is distributed between the retained FedEx entity and the spun-off FedEx Freight, that will materially clarify the leverage picture for the remaining company. Right now, we're looking at a consolidated debt figure that includes a business that has since been separated.
And third,
watch the 19.9% retained stake in FedEx Freight Holding. As FedEx Freight begins trading as an independent public company, its market performance will inform the value of that retained interest on FedEx's balance sheet. If FedEx Freight trades well, that's incremental value for FedEx shareholders. If it trades poorly, it's a write-down risk.
now let's do the if wrong clause. What would prove the core thesis wrong?
Our thesis is that FedEx is in a structural reset phase, deliberately engineering a leaner identity from a position of financial strength, not distress. Two things would prove that wrong. First, if the transition period report reveals that the Federal Express only business carries a disproportionate share of the $23.45 billion debt load and generates operating margins materially below the 15.9% we see in the consolidated FY2025 figure, that would suggest the restructuring was driven by financial stress in the core business rather than strategic clarity. Second, if FedEx Freight as a standalone entity immediately outperforms the retained Federal Express business on revenue growth and margin, that would suggest FedEx separated the wrong asset, that the LTL business was the growth engine, not the drag.
Let's revisit the core thesis. Does the full weight of evidence from this filing confirm, weaken, or modify it?
The evidence confirms it, with one important caveat. The $13.31 billion cash position, the 15.9% operating margin, the $4.43 billion net income. These are not the numbers of a company restructuring under duress. The structural changes, spin-off, fiscal year change, segment consolidation, are consistent with a management team that has the financial runway to make deliberate architectural choices. The caveat is the debt load. At $23.45 billion in long-term debt against a post-spin revenue base that will be smaller than the $34.37 billion we're analyzing, the leverage picture bears close watching. The thesis holds, but it's not unconditional.
One valuation framing sentence to close?
At current margins, and with a $13 billion cash buffer, this equity is priced like a company executing a controlled transformation. But the post-spin leverage ratio will determine whether that transformation is a strategic upgrade or a financial tightrope.
Mike, this has been a genuinely complex filing to unpack. Structural changes layered on top of strong financial performance, with a lot of the operational details sitting in the notes rather than the MD&A narrative.
And I want to reiterate for our listeners, we've been rigorous today about distinguishing what the filing explicitly states from what the structure implies. Where the data wasn't in the extracted content, we said so. That discipline matters.
It does. That's a wrap on FedEx FY2025. I'm Sarah Chen.
And I'm Mike Torres. Thanks for listening to Aviation Intelligence Weekly.
Standard disclaimer: nothing in this episode constitutes investment advice. All analysis is based solely on publicly filed SEC documents. Consult a qualified financial advisor before making investment decisions. We'll see you next week.